recording. Yeah, how's everyone been? You well, Josh? You want to do any?
Thanks for asking. Everything's great. Really appreciate it.
No problem.
It's awesome to have you back here.
Yeah, it's been a
Looking
while.
forward to this one.
It's been a while. I've been AWOL
Yep.
for a few months. It's been a while since I've been inside an escape stream. Most of you know my wife was pregnant. She has now given birth as of about 10 days ago, so just dealing with that at the moment. Being busy, super busy. What's up, Christy? Thanks, Boomer. Thanks a lot. Yeah, I haven't intentionally ignored all of you, I promise. So I'm coming with some of the sauce to catch up today, hopefully.
All right. We are ready whenever you are.
All right, let's go. So I did a call on 2 days ago, I think. It was sort of a pre-call to this, and actually I did it upside down, as I said. It's actually part two, so we'll just get into what part one actually is and what I intend to talk about, and meld everything together. Whatever I've shown you so far, I'm making the assumption again that most of you or all of you have watched the previous streams that I did, especially the order block journey that I took you guys through on my very first stream, which ended up being the TTFM or T-Trades model, right? You guys remember that? You should, right? Because that OB model that I developed becomes the core understanding of fundamental or foundation for what comes next or what comes after. Okay, it's an ever-evolving puzzle, and we're just now putting all the pieces together. So I've been cooking with a couple of guys inside my Discord, and what I'm about to show you is the easiest part of the entire model that I can show you that would make sense. And what it would actually entail is that by now, like I said, the assumption is that all of you guys know what a flash or a zoom model is, and if you don't, we'll just give a quick recap. The zoom model that I introduced came from TCM, and it's basically when we have what we termed an opposing liquidity run. So it looks something like that, right? We have an accumulation, you have a failure swing, you have a manipulation or an opposing liquidity run above the highs, and then we go on to all of the other stuff, right? CSD, retracement, expansion, right? Look familiar? This is the zoom model. And there were times where when I first started with the ICT or price action journey, that I would always go in looking for this, right? This pattern, so to speak. But it becomes more than just a pattern. And it also became clear or evident that there was more to this, because there were times where we just created a high, went down, created a lower high, and then fell, right? Or expanded. So this became the flash model on the right. So the zoom takes liquidity. You could call it a breaker model if you wanted to. And the flash, which introduced the flash ranges, became a lower high or a higher low before price moved away, right? Now, I want to bring this back to you guys, because if you haven't realized it yet, no MMXM model can begin without a flash or a zoom. Does that make sense? It's either going to be a flash or it's going to be a zoom. So in the understanding, or if we take away this understanding and we look at what an MMXM model is, you guys know it to be an original consolidation, right, of some sort, right? Let's call it a zoom at this point. And then we have CSD, retracement, expansion, first stage of accumulation, second stage, terminus, smart money reversal, and then we start pushing higher, low risk entry, first stage of accumulation, sorry, here, those with distribution on the way down, second stage coming in something like that, and then back up to the original consolidation, right? Does this look and sound familiar to you guys? So if we had to put any, what was that? Did someone have the mic on?
No, I said absolutely. You know, I'm a big
Yeah.
fan of this. So.
Yeah. So just to get through the laborious sort of stuff, LRE, most of you know, is low risk entry, right? And then we have the first stage. I'm sorry if this is being repetitive or you guys already know most of this stuff. I just need you to understand it from my point of view before I get on to what comes next, right? So first stage, then we go on to, let's see if we can do that, put him down here. Second stage, or the silver bullet as they like to call it, right? So second stage, and then we have the smart money reversal, I suppose, right, at the bottom. This is the basic understanding that we all have if you've ever studied an MMXM model. And the background to this is that every range between a flash or zoom at the top to a flash or zoom at the bottom, back to a flash or a zoom at the top, generally will be aligned with whatever the current order flow is. It is only when an objective is met at a key level, we may not know what that key level is, previous day high, low, session high, low, monthly high, low, weekly high, low, whatever it is, right? A key level. It is only then, if you haven't figured this out as well, that you'd start to see a dealing range being created, in meaning we tag buy side, we tag sell side, then you get the retracement and expansion giving you the dealing range. Every other range in between should start to develop order blocks, and none of these should ideally break structure, right? So you'll never have a case where we come down here, then we sort of do something, come back up here, then we go down there. Most of these trading ranges should have protected highs on the way down and protected lows on the way up. So if we understand this part of it, it means that we know in a bearish model or a market maker sell model that each of these highs should be protected, and we should never close above them, right? Because the moment you start closing above them, what happens? Oops, that was a terrible line. The moment you start closing above them, it's CSD, right? That's what we look for. We look for a swing point that we close above, and then you can start using the TTFM model or any of your other models, right? But basically it involves closing above a swing point after a key level is tagged, and this is when we like to play. It is only then that all of these highs created on the way down will start to get tagged as liquidity. On the way down, they wouldn't. On the way up, everything's fair game. Now, we could use the term order block loosely because what we know an order block to be is a series of a candle or series of candles that take liquidity before going higher or lower. But in this case, it could just be an up candle or down candle body range before heading higher or lower, not necessarily to the strictest definition an order block. So when we understand what's going on here, this becomes the ideal delivery that we would like to see, right? If we're looking at going from one point to another, point A to point B, or point B back to point A, this would be what an ideal delivery looks like. It would have a low risk entry, you'd have a smart money reversal at the top or bottom, CSD, low risk entry, ideally first stage of distribution, second stage, and we know speed comes out of the second stage, and then we get the smart money reversal shifting from a market maker. Let's see if I can draw this out really quick. Right, so we move from sell side of the curve to buy side of the curve, right? Right, so I'm not sure well, I'm sure that the way that I'm going to show you how I use the standard deviations here is not used at all or not widely used by many. But the way that I would use these is coming from the understanding that within a market maker buy model, we have market maker sell models and market maker buy models within, it's all fractal, right? So within a sell model, you could have a buy model, a buy model, buy model, and within a buy model, you could have market maker sell models. And for me, this all comes down to the fact that when I look at price, and I'm going to be very specific about certain time frames that I'm using, right? These are all Fibonacci based time frames. I'll keep it simple. We'll start at a daily time frame. The next time frame down that I would use is a 729. The time frame below that is a 243, then an 81, a 27, 9, 3, 1, and then you go down to 15 second, right? Because what happens in any delivery is that when we have, for example, a daily delivery that's occurring, right? A high time frame daily delivery, we understand that when a daily delivery starts, what I'm telling you is that in a daily delivery, the first delivery sequence that occurs would be on a 729 time frame, right? When we have a consolidation and we start moving, it would deliver into 243, and as we go, it will deliver 81, 27, 9, 3, and 1, right? And within each of these, if this started a 729 delivery, within each of these, you'd have a 243, 81, 27, 9, 3, 1. And if this started at 243, you'd have an 81, 27, 9, 3, 1, so on and so forth. You get that idea, right? So keeping that in mind, we are going to become very specific with the time frames we use and where the hunting or what our expectations for these should be. Now, before we get into those time frames, I want to share specifically when we understand that there are more than one delivery occurring on a higher and a lower time frame, it means that standard, I'll call it Dexter fibs, quote unquote, using one Dexter fib doesn't really cut it, right? Now, how many of you truly understand the Dexter fibs? I've discussed this in the call that I did on a few days ago. I'm not sure if many of you watched it. but the basic understanding of a Dexter fib would be, let's see if we can give this a background. There we go. Is that when the smart money reversal occurs, right? Remember this? We want to see expansion through the 0 to the 1. At 1 to 1.5, what do we know about Dexter fibs, or these retracel reversal fib points? At 1 to 1.5, we expect some sort of consolidation, right? So it could be a point where you have this being a low risk entry. Inside here, you have an expected consolidation. And at 2 to 2.5 standard deviations, what do we know? That at 2 to 2.5 standard deviations, we can expect either full-on reversal back to OB, right? Let's say this is the ideal delivery, and then we deliver to 4 standard deviations, or we just fall off a cliff in this case, and we never get to 4 standard deviations. Now, the way that I want to show you how we fib these is that I want to fib this in 2 ways, right? The first way is fibbing the accumulation range like we have here. Find a low, find a high, put the fib on, right? This is the first delivery, or what we call the smaller delivery. So in this delivery, you have the same expectations, where low risk entry, 1 to 1.5, you expect a consolidation, 2 to 2.5, retracement or reversal, and then terminate at 4 standard deviations. And what I want to add to this is a second delivery that you would normally use from the low, but my anchor point, which I didn't mention in that video, is that I'm not going to use it to the top of the last swing point, right? Or the bottom of the last swing point. I'm going to align these fibs such that 1.5 standard deviations lines up with 2.5 standard deviations of the smaller fib. So what that means is, when the smaller delivery approaches 2 to 2.5 standard deviations, I expect a retracement inside the 1 to 1.5 of the larger delivery. Does that make sense? So in this case, I drew it, I think, a bit too perfectly, but it would look something like that. And we would see this point aligning with that point. Everyone following? We'll get into the examples now. Yes, no? Are we all there? Following? Simple enough to understand. Because it's going to make, it's going to, if I didn't tell you this, it's going to look as if I'm fibbing the second or the higher delivery with an anchor point that's in the middle of nowhere, right? So, if we are all, ones in the chat, if we are all happy with the understanding of there being 2 different time frame deliveries, a smaller delivery and a larger delivery, we fib the smaller delivery, and then we line up the larger delivery, 1.5 standard deviations lines up with 2 on the smaller. So that was the case where we had an OLR, right? Or a zoom SMR or fractal. In the case where you have a flash range like that, what would we fib here? In this case, what I would ideally use is I would use this guy as the smaller delivery right there, and I would use this point, this low, to a floating anchor point until 1.5 lines up with 2.5 of that guy. Does that make sense? So in the case where you have a flash range reversal occurring, we fib the first consolidation, we take the lowest swing point or highest swing point, we fib it there, and we anchor 1.5 to line up with 2.5 of the smaller, right? That's just the difference if you had a flash or a zoom. All good? We can move on to some examples. Yes? No? One's in the chat? All good? You want to see examples? I'm sure you want to see examples, right? Let's get into it. Okay, we're all happy with the MMXM model shown here, smart money reversal, all of that kind of stuff. I can get rid of that. And so far, we all understand the difference between a flash and a zoom model. That should be a given. Right, so if we go back to whatever PA we can find, right? I could go over today's PA, I could go over quite a few days. Let's take PA from the top here, right? Let's take PA from the top. We know that whatever happened or whatever occurred down here led us to this point where we started to see a dealing range or a lower high here, in this case a flash range being created, and we weren't quite sure where this could have ended up, right? I could have taken down here, and if I just show this to you quickly, the brush tool, if this is what this looked like down here, right? It's an OLR or a zoom range, right? So as tiny as this little accumulation is, I'm going to try and be as accurate as I can with this guy right here. This would be the first range that I would have fibbed out, right? The second range would come from the very low to a point where 1.5 standard deviations lines up with 2.5. Right there. Let me just get to this side. Can you guys see that? 1.5 standard deviations lines up with 2.5 of the smaller guy. Which means your expectation is that at 4 standard deviations, this should become, or this should approach its end. We understand that at 1 to 1.5, we should have seen some kind of consolidation. At 2 to 2.5, we could have seen a full retracement or reversal. And terminus at 4 standard, 3.5 to 4 standard deviations. So let's just take a look at what happened to the left there. You see how this delivers right there? That's your terminus. If you understand that this is your terminus, or this is where this delivery should have ended, then we could understand that a next delivery should start here, and we can fib that going down. Now there's a few deliveries on different time frames. I used a couple deliveries inside here to get me down here. You could have used, on a larger scale, we could have used this fib delivery right here. There. And we could have used a delivery from the highs, because this was a high, this was a low, this was a lower high before we fell off a cliff with the Trump candle. So the second delivery, or the larger delivery, would be 1.5 lining up with 2.5, something like that. And what we know is that we should have expected some kind of consolidation inside 1 to 1.5, right? A tag of that consolidation. So this becomes very important. When you have a consolidation inside the 1 to 1.5, ideally you want that consolidation to be tagged, or your entry is going to be as close to the consolidation high if you're bearish, if you want to short. If you're bullish, most of your entries are going to be close to the consolidation lows, because we don't ever buy at consolidation highs and we don't ever sell at consolidation lows. Does that make sense? So you can see if I use these two deliveries to guide my process or end goal here, at 3 to pretty much gets the delivery coming into the bottom here, right? Give or take a few ticks here. So I shorted inside here, I got taken out, but it didn't stop me, because what happened inside here, when I talk about shorting consolidation highs or consolidation lows, if we understand that the delivery should end somewhere down here, right, 24,250, if I went down to a lower time frame on that drop on that day, let me just scoot over. I'm sorry if this is seems a bit boring, but it's gonna make a lot more sense and it'll be a lot more fun soon. Just have to get through a few examples just so I have so I know that you guys are fully understanding what's going on here, because this is the difference between playing every swing, right? Every swing. Just give me a sec. This taking a bit of time here, but it is loading up. So yeah, I'll show you again, Bala, but I just explained how I chose the spots where to fib, right? But we'll explain it again. So my first short inside here came in off a consolidation high. I think I still have the markings on here. And like I said, if you're bearish, you want to short at consolidation highs and long at consolidation lows. So if we look here, if I had this point coming down here and I had a consolidation occur right there, right? I marked it off in orange or whatever color this is. The moment we tag the low, you can see how if I sold the low, I would have seen my ass, because price just pulls back. But where does it pull back to? If I'm bearish, it pulls back to the consolidation high, and that's where I'm going to play, right? And where I'd like to play is as close to the consolidation high as possible. So what that means is, in this case, we're going to use a specific PD array here, which is a wick CE. So if I took any wick CE, like here, see if I can get this in here, and just put an EQ there. That's where my entry is going to be, right there. You can put your stop, give it a numerical value, 20, 25 points, whatever it is, depending on how violent the move is. My entry was at the wick CE here, but more importantly, close to the consolidation high as possible. We came in here, we moved here, and then we just started falling off a cliff. This was about 400 points at the time, right? 3 to 400 points. 25,080 to 20, yeah, but about 300 points. We then had another consolidation inside here. We fell down, and then price pulled back inside here. So again, I'm looking for close to the high as possible, but you could just use the CE of those wicks, because at this point I'm only going to get bullish when price starts to close above these ranges, pulls back into that range, has a change in the state of delivery and then moves higher, right? Because obviously we don't buy consolidation highs and we don't sell consolidation lows unless we break through those consolidation lows, come back in, and then move. Is that a simple enough concept to understand regarding consolidations? Sell close to the high, buy close to the low. So in my Discord, I just did something like this, because all of these ranges are now flash ranges for me, right? Or trading ranges. This is a flash range right there. We should never close above it. You could have done an entry at 50%. I put a hammer icon here, and lo and behold, where does this go? Falls off a cliff, right? We get a retracement, and then it's off to the races again. This is another 300 or 400 points. Now, every time we get something like this, which offers us a zoom or a flash model, and we change the state of delivery, we can do, we can flip them, right? Here's a high, here's a low of the accumulation range. Let's put that on right there, and let's actually make that black for now. Right, there's the first leg or the smaller delivery that I'm expecting. Inside inside of that, the larger delivery would be the wick high, again to a point where 1.5 standard deviations lines up with 2.5 standard deviations right there. So what are my expectations here? If we have reversed from here, is this not the low risk entry sitting inside here? We scoot on lower, inside 1 to 1.5 standard deviations of the smaller delivery. We should have expected a consolidation to occur inside here. Now, what I like to do is take a horizontal ray and put it at the point where 1 to 1.5 standard deviations zone starts. And if this is the candle that's closing through it, I tag that high or that low right there. Because I understand that if I want this to deliver lower, that they should want to come and take this guy out first and then move lower. When they don't take this guy out and they start moving toward 2 standard deviations, this is when you're going to find a situation where at 2 standard deviations or 2.5, you're going to see a huge pullback to come and take that guy out and then move. Make sense? So at 1 to 1.5, in an ideal world, you would see a consolidation. We want that consolidation high or low tagged, and then we want continuation. Same story here. You have 1 to 1.5 consolidate of the larger delivery. Now look here, right? We know that something should occur in this zone here, meaning a retracement or a reversal right there. It's not random that at this 2 to 2.5 standard deviation of the smaller zone or the smaller delivery, we get that pullback into an untagged high of the 1 to 1.5. Should there have been a consolidation in that zone, we would have been looking to short as close as possible to that zone. Right? So at this point, we expect retracement to occur. Where does the retracement go? To a consolidation high, or a point. In this case, there's no consolidation high. It is a candle high of the candle that closed through the 1 to 1.5 standard deviations, right? We come there, and then we start delivering back to where? 2 to 2.5 of the larger delivery, and 3.5 to 4 of the smaller delivery right here. We get a pullback, and then price starts delivering. Give me a sec. price starts delivering to 4 standard deviations down here. So can you see how fibbing 2 different deliveries here will guide me as to where I could expect a reversal to occur from? And it's not just about where I want to close my trade, it's also where you can expect the trade to turn around from. Because if I took this both ways, right? If I took just this delivery right here, let me get that as accurate as possible. To that low right there somewhere. Can you see here how the smaller delivery terminated almost exactly there? Sometimes it gets to a point where you could just literally put an entry at 4 standard deviation. And I'll show you an example or two of that. So if we expect a retracement or reversal to occur here, where do we expect it to go to? Here. And we already have the larger picture in mind, but if I wanted to play a smaller move, then what do? I come here, I flip this guy, and then I flip a larger guy next to him. From there to a point where 1.5 lines up with 2.5. Let me just turn the magnitude off. So you choose them because those are the ranges that will give you a flash or a zoom off of the lows. No one is asking you to actually catch the actual high or the low. You're going to find at your key level, you're going to okay, let me put it to you this way, right? At no point in this delivery right here did we close above a swing high. You agree? Until this point right here. That's where the change in the state of delivery occurred. That's where you went from market maker sell model to market maker buy model. At any of these points, you didn't do any of that. At this point, you did. But we don't know how far that should go. We can use the fibs as a guide. We could have higher time frame ideas like we did here. So these are just guides. Now here, the smaller delivery tells me we're starting to move at 1 to 1.5 of the smaller delivery right here. If I just take the candle that closed through it right there, we know that in order for this to move lower, ideally I want to come and tag that high and then start moving. Where? To 1 to 1.5 of the larger delivery, 2 standard deviations, and then deliver to 4. This delivery that I chose here is completed for me here, but by no means is it the end of the entire delivery. It's just an end of that specific delivery. I could have come in here and every time you found a flash or a zoom model, fib that and have expectations of where price should head to to the downside. But can you see that it's not random that the consolidation high or the candle high in this case that closes through the 1 to 1.5 standard deviation zone, ideally I want to see that tagged. They did tag it here and move away, but close below, tagged, moved away. Let's get rid of these drawings. We'll go through a few more. If any of you have questions in the meantime, you can ask me about them in the chat. Again, you're going to choose the delivery when you see a zoom or a flash occur. Let's have a look at your picture here. Yeah, so you can see why that circle that you put in your picture there is anchored seemingly in the middle of nowhere, right? Because if you look closely, the circle where you see 0 there, look at where 1.5 of the larger delivery lines up with 2.5 of the smaller delivery. That is why I told you in the video before that that video is part 2. This is how I actually use those flip deliveries. So at any point you have a flash or a zoom occurring, we could start to fib them, and believe me, once you see it, can't unsee it. We could have expectations of where these things should deliver to. Right? Find the delivery, line up the higher one where 1.5 lines up with 2. And you'll find crazy things happening where between 1 to 1.5 standard deviation zones, if this is a consolidation and we haven't tagged, let's call this the consolidation here. Ideally, we want to tag as close to that consolidation low and move away. Moves up, just misses 2 to 2.5 standard deviations here. Retracement here, starts delivering higher here. 3.5 standard deviations, comes back, does tag that low, strangely enough. And I think it delivers to 4 if I'm not mistaken. Yeah, it does, right? So let's put a line at the low of this consolidation, because this is going to become sort of a key level for you guys, but just something to have on your chart if you can line up 1 to 1.5 standard deviations with something, right? Let's see right there. So this delivery from here goes here, comes into 1 to 1.5 standard deviations, 3.5, retracement, delivers to 4. Yeah, you could do that, right? The actual better way to do it, and I'm not going to do it here, I mentioned it in the previous video, is there's, just like the time frames that I mentioned up here, 729, 243, 81, 2793, use an EMA. Every time price, put on 5 different EMAs here, 6 different EMAs with these numbers in mind, until I can get the guys at 2 to give us something. I won't show you that. It's not needed. It's not really needed, but it's a good little confluence that every time you tag an EMA, you can flip that delivery, right? So now we know that a delivery ended up here, which means I need to look for a flash or a zoom, and if I find it, I can then fib this guy right here, and this guy right here. Let me just turn this off for a second. Again, swing high, fibbed down until 1.5 lines up with 2.5. Notice that inside here we had the low risk entry, no real consolidation in that 1 to 1.5, delivers to 2, and again, not random that we end a delivery at 4 standard deviations right there, almost to the tick. and 2 to 2.5. So at this point, you're thinking this could probably come a little bit deeper, tag some liquidity, and then deliver to 4. It does actually the opposite, just delivers to 4 standard deviations here of that delivery. This was yesterday, right? This was yesterday. This becomes interesting here now, right? Because me personally, I know what level I wanted to see hit here. For me, it's every day. In fact, it's 4 p.m. My guys in my Discord will tell you that. I've mentioned that to you before. 4 p.m. close every day. If you're above it, you want to trade back to it. If you're below it, you want to trade back up to it, right? Let me just see where, roughly there, right? Roughly there. That's 4 p.m. So at this point, if you thought about the open occurring, flushing down, we had a huge gap since 4 p.m. close was all the way up here. We wanted to sweep liquidity and drive price towards 4 p.m. But let's get some fibs involved in this. Right. This case, we've got a flash model down here, zoom model. Here's your first delivery right there. So I get that right. And your second delivery will flip it from the bottom here. Line up 1.5 to 2 right there. So I know now that a delivery should be ending roughly around here. See that? I know what I want to see happen inside here on the smaller delivery. A consolidation. Tag the low of the consolidation, move up. I know what I wanted to have seen inside here. Tags 2 standard deviation, pull back. And remember, it's as simple as this. If you know the objective is all the way up here, would you be shorting the shit out of this and look for some Hades sort of price action? No, you won't. What you are better off doing is every time you see a consolidation, mark it off. If you want to short, it's only going to occur at the top of that consolidation. Every time you get to the low of that consolidation, you're going to long. Every time you get to the low of that consolidation, you're going to long, because order flow is bullish. Every range created inside this piece of price action from this low to take you to that high is going to be I'm confused. He uses initial fib before the dip for some examples and for some after the dip. Yeah, because remember, Altaf, you came to, you probably, I don't know if you were here from the beginning. It's either going to be this, right? And I fib this guy. And I fib this low right here. Or it's going to be a point where we get something like this. And then we move higher. I fib this guy. And I fib from here going up. Right? Now, depending, like, I could tell you that down here, if I wanted, I could have fibbed that right there. And that right there. And then I could have taken this guy from the lows down here, lined them up again, where 1.5 meets 2.5. This delivery right here only gets me to there. Okay. Now, we shorted this inside here yesterday. And again, you're going to do two things depending on the time frame you are on. You see, when you have a case like this, right, where it's all sort of drawn out consolidation before an actual move, I don't ideally like to fib something that looks like this. I could, right? And I'm not saying that it won't work, but ideally when I put a fib onto price action or candlesticks, right, I want to see price actually move in my direction. So if I did something like this, once it got in here, it just started to sort of meander inside here before it fell off the cliff, right? But if I just looked inside here before that occurred, let's just do something here. Let's get rid of this guy right here. Are you guys still with me?
Yep.
Thanks, Josh. I could have fibbed. Let's zoom in here. Now, these may not help you when price moves like a rattlesnake, right? Unless you shorted at 4 standard deviations up here and you were willing to endure all of this. Your next goal is, or the idea of these fibs are to give you a guide as to where you can start entering, because like I said, look at even the smallest time frame. When you have a market maker model occur, you want to see, even if it's a single candle, consolidation, low risk entry, consolidation, first stage, consolidation, second stage, and boom, smart money reversal at the bottom, right? So you have an expectation that these things should occur inside each of these levels. It becomes a bit more difficult when you don't see those things occurring inside there. Let's just line this guy up right there. Right there, that's more or less it. Okay, can you see why I chose this? It was this range down here, that OLR down there, and then we fell off a cliff. We had a consolidation inside here, and then boom, we fell. Where did it go to? Right there. 4 standard deviations. At this point, you're going to start hunting reversals. Yes? No? If I'm hunting reversals, we're gonna go, what does the PA look like at the bottom here? Is there any willingness to expand through the fibs? Is this a flash or is this a zoom? If it's a flash, I can do something like this. And we can use the second fib from the low. Again, line up 1.5 to 2.5, somewhere around there. Let's just get that a little bit more right there. Now I have expectations of a delivery that's telling me it's likely to go about as high as this, right? It's also telling me that inside these standard deviation levels, 1 to 1.5, right there, if there's a consolidation low inside here, in order for me to move higher, I would need that low to be tagged and then move. One to 1.5, right there. This was my long today, by the way, when I got to my computer. Right, that's the zone this is the low right there that I longed. Right there. Let's zoom into that. This is the consolidation low at the 1 to 1.5 deviations. Price comes in here, comes down here. Now this one I front run because obviously I had expectations, and my target was up here, which was a 729 CE, I think, right? So this gave me a decent enough move right here, which I then shorted because once I'm down here, let me see if I can zoom in just a bit more, right? You understand why the red level was here? It was the consolidation low right there. We'll get rid of that. That's the reason for me longing. And once we get here, right, this should be, you guys can see just this piece of price action right there. We could go two ways about this again. I could go this low to that high, and I can go this low to a point again where 1.5 lines up with 2.5 right there, and I short that right there. Now I chickened out because this hit a PD array here, 729 PD array. I didn't blind short this here. My short actually came in right. Let me have a look. I feel like I'm boring you guys with this kind of shit right there. That was my short there today. I actually wanted much lower pricing, but then again, let's look at this, right? That's one. It still gets me from how you don't take the lowest and go to the left sell side swing. Yeah, because we're fibbing two deliveries. We're fibbing two deliveries here. We're not just fibbing a single delivery. I'm fibbing both. But the trick is in aligning my MMXM expectations, right? The trick is aligning my MMXM expectations and looking for specific things inside these levels. Now, one of the guys inside my group, he said a very interesting thing to me a few days ago, and maybe it's just me and I never had any thoughts about it. Josh, maybe you did. That a low risk or a first consolidation on an M1 is actually the low risk entry on an M3, right? But I'm not specifically talking about M1 and M3. I'm talking about a smaller time frame and a higher time frame. Like the first consolidation on an M3 is actually a low risk entry on an M9. The first consolidation on an M9 is actually the low risk entry on an M27. The first consolidation on an M27 is actually the low risk entry on an M81. Which means if you have even higher insights, that I can take this entire leg down here and that entire leg down here as one even higher time frame, And now look what happens. Because I'm not thinking about this as an M1 delivery inside here. I'm thinking this could be an M3 delivery right here. And if I have that kind of foresight, then right there, that's what we get. Did that part make sense to you, what I just said? Josh?
Yeah, I'm here. Just muted the mic.
Yeah. Did that make sense? That the first consolidation of a lower time frame is the low risk entry on one higher consolidation or one higher time frame. Which is why I could use this entire leg here and that entire leg up there instead of thinking this is just an M1 delivery down here. If I think even higher, it's not.
Yeah, the lining up of the fibs is something that I haven't seen before, and it just kind of requires me to get a little bit more hands-on approach, if that makes sense.
Yeah, it's just a simple process. The swing high in this case is always going to be your anchor point. It's only the swing low that's seemingly anchored in the middle of nowhere. If I had to show you something like this and you see a 0 in the middle of nowhere, you're going to be a bit confused, right? But if you see that 1.5 lining up with 2.5 right there, it's always going to be that on my chart if you see that right there.
I really like what you were saying also about the candle that closes or confirms the one. That's a really nice insight.
Yeah, it is.
I never looked at it like that.
It is. Because let's have a look. I'll show you where I shorted this guy today and where I closed out. So this didn't really give me any insight here today, right? Down at this low, it just came in here and it fucked off. I didn't want it to go higher, to be honest, today. But when it hit a 243 external PD array, and I'll talk to you about that in a bit. When I came in here, I opened the chart, and I said, okay, we had this high, low, higher high, no real follow through yet until here, right? Which means this little guy up here becomes a low risk entry, right there. Which means anything close to this fucking high here or this CE of that wick at that consolidation high, let's zoom in there a bit. I came in, I saw this consolidation. We started to close below lows to the left. I'm going to get rid of this red line right here. And I'm going to put on a CE or wick CE right here. Let's get there. And EQ. That's where I shorted this guy right there. There's almost no drawdown on that one.
Gorgeous.
I added a few positions inside here as well. It's the same. It's the same idea over and over again. It's just that when you start to see it, right? When you start to see it, there's certain gears that start to shift, and you can see here. There's one delivery from here to here. Let me just put a background on that. And there's a second one right here that I had marked on, right here. And this delivery ended at 4 of this guy and 2.5 of that guy. But for me specifically, again, like I said, go and put, let me do it for you, or just see if I have it on here already. Previous days, 4 p.m. My guys know that every day, this is what I'm looking for. Is this 4 p.m. here? Yeah, it is. This line right there. If 4 p.m. is below me, I'm going to be targeting this guy every single day. Everything else, using LD Pro, using my 6 to 9 range or my 9:30 to 10 range, I could put that on. You're going to see they all line up. This is the 9:30 to 10 range here. Where did we come up to? 0.25, 0.5 standard deviation. Look where it goes. Down to 1 week deviation on the other side, right? These are all extra confluences you're going to use. But this one specifically was 4 p.m. on the previous day, treating it as a gap. If we opened up here, trade it down, trade it higher, come back, fill the gap. Now I'm treating all of this as something even higher at this point in time, to be honest with you. That if I step up a few time frames, I'm probably going to treat this as, you can go back in your own charts and do something like this. I'm going to draw it out for you. CSD, low risk entry. If you get the idea. We just have to figure out how far can this come into, and why would we expect it to come all the way up there. Are we on an M5? Let's put on a few fibs that are of one lower time frame. M3, M1. Let's go M1. 4 p.m. Previous days 4 p.m. Is what I use. Always. It's always going to be previous days 4 p.m. I have two options at this point. This tiny consolidation before this OLR, or this flash range right here. Again, remember this is a guide for me right there, and this low right there. Line that fib up. Now we have expectations, like you can't make this shit up at 2 to 2.5 right there, which is 4 of the smaller delivery. You see how it starts to fizzle off inside here. Now what's interesting is that in 1 to 1.5 we never had any consolidation low tagged inside here, so there may be a situation that they do some crazy shit like this. Somewhere there. Tags this low right here. Right there. And then we start delivering up here, right? If that happens, that'll be awesome. You know where to load up for the next buy. So I mean, this does. Did you say something?
No, I was just unmuting.
Yeah. So it's one of the reasons, and I mentioned in the previous video, that I could, at 107 or 108K, I said 125K next on BTC. That's also not random. Let's just have a look at the fibs right there. Have a look at everything. And for those of you, I think I'll clip that portion of the stream and I'll post it to you guys I'll show you what I'm talking about just now, right? Let's go here. Oh, one more thing. Let me just show you this. You probably appreciate this, Josh.
Absolutely.
And it's a pity that we don't know about, oh, I didn't know about these things back then, but let's look at, forget the arrows here, right? These are just crazy ideas that I had. But let's talk about 1 to 1.5 standard deviation zone right there. If my fibs are aligned correctly, there's a consolidation low right there. In fact, right at the red line, that dropped to 16K. See that? Right there.
Kissed it.
Yeah. Kissed it and fucked off the other way. Right there. It's probably going to be closer to a wick CE of this consolidation low here if I eyeball it. Yeah, it is. Scroll down, yeah, sure. There you go. So if you look at what I did here, it gives you some kind of crazy outlook as to where NQ could go. But if you look at where we are right now, right there, things are not so good. Again, there's the consolidation low here as well. Right there, let's have a look. That's the consolidation low, and then they tag that in the same one. Crazy, and then it just flies the other way. So at 2 to 2.5 standard deviations here, they come back to the 1 to 1.5 consolidation zone, head higher to 2 standard deviations of the larger delivery. They didn't tag the 1 to 1.5 consolidation lows here. They come back with speed and then they move away. So now we know at 2 to 2.5 standard deviations here, we could expect some kind of crazy shit that comes back into the 1 to 1.5 standard deviation range, which also then delivers to 4 standard deviations up there. Okay, that's just a little sidetrack. BTC, right? There's let's have a look. Let's step it up a few time frames so it looks a bit neater on screen. Do all of you think you can go back into your own charts and figure this out? Obviously watch the video maybe one more time. And by the way, this is not even the entire model, right? The entire model has EMAs that they make use of. I am only showing you the easiest portion to take out of the entire model is fibbing 2 different time frame deliveries. So if you look here again, we had a 2 deliveries here at 1 to 1.5 deviation zone. Again, if I get this right, they tag that low right there, deliver higher. Retracement after 2 standard deviations, we use these 2 fibs, comes down here, and eventually delivers to almost to the tick, by the way. Can you guys see this? I'll make it a bit bigger. Right there. See that?
It's impressive.
Up here, two deliveries again. There's your first consolidation. What I proposed on the video the other day is that this was the second consolidation, pretty deep right there. You can go back and watch that. That was the second consolidation, and that there's a likelihood that they tag this consolidation high right here and start delivering to this low down here. So that'll be interesting to watch. But if we take these two deliveries that I got here, that nasty wick on Binance at the bottom of last week, almost to the tick there as well. We could just make that a bit bigger so you can see it. Fun times, right? Fun times. Again,
Very well.
Everything is random. Everything is random. All just a whole lot of random stuff. But the main purpose of me giving you just this specific portion of the entire model is understanding that everything fits together in one giant puzzle. Start making use of two delivery fibs, and inside of them always think MMXM. What should happen at 1 to 1.5? Did they come back and tag a consolidation high or low? Where are they delivering to next? If they've delivered to 2 to 2.5, okay, we could expect a reversal or a full-on reversal or a retracement. Where would that retracement go to most likely? Did they tag that 1 to 1.5? Perhaps the 2 to 2.5 could deliver to the 1 to 1.5 consolidation high before finally delivering to the 4 standard deviation low, right? Think MMXM in everything that you do, because the ideal delivery will have a low risk entry, first stage of distribution, a second stage of distribution, and then the silver bullet delivering to a smart money reversal. I'm always thinking MMXM. Now, the final thing that I want to talk to you guys about is when I mentioned that time frames have unfinished business that needs to be conducted before they can move away. I was not, I wasn't kidding, right? There's a sequence that needs to occur, and if you start from the daily or start from a daily or 729, for example, right? There's a lot of stuff I can get rid of right here. But if you are familiar with your ICT PD arrays, right? We're going to use internal to external, and we're going to use FEGs, breakers, volume imbalances, rejection blocks, wick CEs. So what happens here is when a 729 delivered externally right here, okay, the next 729 should deliver internally before delivering externally. See that? And if we have delivered externally here, the next 729 should deliver internally, and it's not random where it delivers to. It delivered to a 729 FEG. If we've delivered internally on a 729, you know that it should deliver externally on a 729. Right there. We deliver there, we come back here, wick CE of this 729 here, we deliver externally again, after which we deliver internally where? 729 volume imbalance. While all of this is happening on a 243, one time frame lower on the Fibonacci time frames, you're watching what's going on the 243. because all of the time frames have to work together before an explosion or an expansion can occur. So at this point down here, we deliver to 243 FEG sitting inside here. From here, we deliver externally. We come back internally, we deliver externally 243, internally 243, externally 243, internally 243, which is also a volume imbalance, and from there we should deliver externally 243. Come back down to an 81. While all of that is occurring on a 729 and a 243, the 81 is doing the exact same things, delivering externally and internally. Wick CE right here, moving away internally, externally, externally, volume imbalance, and it all goes down stepping time frames. What is a 27 doing? What is a 9 doing? What is a 3 doing? What is a 1 doing? And when they have left no liquidity in that range, that's when they can leave the range, right? So if we think about working from the highest time frame up coming down, we have an idea on when the next or where the next draw should occur. If a daily delivered internally, it should deliver externally. If a 729 delivered internally, it should deliver externally. It's how it gets to that external using the 243, the 81, the 27, the 9, the 3. It's all the same thing. So at the highs here, I wanted to short here based on, let's look here. So this is where I chickened out, but where my ideal short was going to be, right? It was going to be at the CE. Remember I mentioned CE? There's a CE right here of the 729 candle, and there's that wick into it, and then there's the death right there. Because if the 729 has delivered externally, internally, we deliver internally, it should want to go externally. And you'll find that it won't go to some random place. It's going to go to a 723 FEG or OB, O breaker, whatever you want to call it. So the same things are happening even today, right? I wanted the 729 CE here. I got it. It's where my long was set to. This wick up here comes into a 729 OB inside a 729 breaker before we fell over. So if we've delivered externally, we now have to wait for the next 729 candle, the next 243 candle, so on and so forth. They're not random in how they deliver. If a 243 candle here delivered externally, look at the low that happened right here. It's just a 243 FEG down here internally. Now all of you are so very quiet. I'm not sure if it's shock or if what I'm saying sounds foreign. But
I've actually personally not used any custom time frames like this before, but
time frames are based on Fibonacci.
Yeah.
Yeah.
I got you. So it just requires a little bit more studying. That's it.
It does.
And
but the basic premise is use the same idea on an H4, H6, H12 daily, hourly, whatever it is. The idea of the core fundamental of this, or the takeaway, should be that every time frame needs to do a certain job and finish any unfinished business on that time frame while still delivering on higher time frames, right? And once they've all done the business, so to speak, they can now leave the range. That's all that it is. Complete the business, leave the range. 729 Devil's Mark, PD array here. When we went up here, this is what we're targeting down here. From here, we're targeting this FEG on a 729 or 243. Here, we're targeting rejection block up here. We're targeting the external up there. When we get to each and every one of these levels, that's where we want the lower time frame fibs to line up with a PD array from these levels, which we can play around with. Now, do that on every and all time frames, or choose one time frame if you have to. Choose one time frame and work with that time frame. Now, I specifically marked off 25.03650 because for me it's what I call an algo draw. When this candle failed to close below this low, its high should automatically be a draw on liquidity. So I'm looking now, how can I get from down here, seemingly externally, to up here internally, with the idea on the higher time frame that all of this that's occurring now is either delivering on a daily or a 5-day or a 10-day, whatever it is, that all of this is or has the potential to be, right, let's look at it this way, a low risk entry on a 5-day chart, or the first stage of distribution on a daily time frame. If we're thinking MMXM, which means if I went to a daily and I started to do things, we can look at it on a daily. Right, it will start to look like the first stage. Let's get rid of that. The first stage of distribution on a daily time frame. Let's do that. Let's get rid of all of these markings. I'll probably redo my charts tomorrow. Let's look at it here. I would probably fib something like that. Reversal retracement. And let's go down. I think my fibs are hiding on higher time frames. Right there. So if this is a daily smaller delivery fib, right, again random, 2.5 standard deviations was this low right here. Retracement, we don't have any sort of consolidations inside here or anything doing much about anything inside here. The second fib would be from this high line, the 1 to 1.5, or 2 to 2.5, something like that. And now you see that this is a potentially first stage of distribution. We come down here to 2.5 to 2.5 down here. Give us a second stage. Like that. And then silver bullet speed to 4 standard deviations. This would be your daily MMXM model right here. Any questions? I think I've covered most of what I needed to cover specifically with using these standard deviation projections and how I personally it's like a humble brag, but how I personally use these to catch most tops and bottoms. Even if I don't catch a top or a bottom, I understand where the delivery is headed to. Find me the nearest consolidation high or low for me to long off of. And that's all that is. Now remember we said something earlier that this could want to come all the way down here. Seems likely, right? Seems likely. Come down here.
Very, very awesome.
Yeah.
Very, very awesome. So for everybody that is still here, please drop some love in the chat. You know, Poison just took basically an hour and a half of his time to break down some, you know, of his advanced trading concepts. And if you guys enjoyed it, please make sure he's aware. It really only takes a couple of seconds to just
Yeah,
drop
appreciate
something in
it.
the chat, and it does go a long way. So if you do want to see him back here, definitely let us know. And I know that he's always invited. So at any point, if you ever want to come back and drop in and share some of your insights, the community does really appreciate it. So we appreciate you, and definitely looks like a bunch of the chat sharing a lot of love. So thanks
Yeah.
everyone for doing that as well.
And yeah, my DM's are always open. Um, my Discord personally is always open to anyone willing to learn. You gotta come in there and obviously put in the work. It's not just come in there and I give you some special bit of information and then it suddenly makes you profitable. It's never the case. This is gonna take a lot of fine tuning, but you know what? The end result is actually worth it because what happens is you start to see or view the market through a different lens, and if that specific lens that we're using is market maker model, and who doesn't like a good I know you do, Josh, who doesn't like a good market maker model, buy or sell. I've just given you a very specific lens to view that off of. And again,
Absolutely.
if any of you are interested in joining my mentorship, you're most welcome. I have created a code which is the same as my Toodegrees code. So if you guys are interested in more range deviation stuff, I posted a bunch of YouTube videos specifically on liquidity depth Pro Plus and understanding how those range deviations work, how we use liquidity depth Pro most effectively. And the promo code's the same, right? POISZN will get you 20% off on that or any other Toodegrees indicator. But if you use that specific code, I think for the next 2 weeks max, I think I'll allow it. If you use that same code on my WOP, you'll get access to my mentorship at 25% off? Yeah, 25% off, right? But again, it's not for your average guy, it's for people who want to be above average. So I don't expect any of you to join, in fact, right? I'm not telling you to join. Quite content doing what I'm doing with my little group of guys, but and most of them are here in this call anyway, so you're most welcome. I'm not denying anyone, but just come with the mindset that this market isn't what you thought it was, and hopefully this call right here is now piecing all of the previous information or the puzzle pieces that I gave you, starting from the order block journey and all of that, which leads up to what this is right now. We've incorporated a lot. We've incorporated order blocks, we've incorporated standard deviations, we've incorporated market maker models, piecing it all together as a complete understanding of how price delivers. Yeah, I think that's me. Appreciate all of you guys for joining. Appreciate anyone that's going to be watching this. I will post it to my YouTube and then share a link with Josh and share a link inside the Escape Discord. And yeah,
Absolutely. We will get that posted, and we really do look forward to having you back at any point. So,
Yeah.
we really, again, thank you for everything. I know that these are the advanced concepts. So even I'm gonna have to go over there and
Yep.
watch the video a couple times. So if anyone else is in that same boat, then just know that you're not alone, right?
Yeah.
So some things are gonna take a little bit more time for you to
Yeah.
basically digest, but once you kind of digest it, you can, more or less decide whether or not this is something that you find that is able to help you in your own charts, but without actually further investigating it, then you don't want to just be, let's call it hard-headed, right? You
Yeah.
want to just be open.
And again, I'm not targeting as well. This is actually targeting a specific type of trader, right? It's one that's slightly above average, one that understands all of the ICT standard concepts, knows what the retracement reversal fibs are, knows what a market maker model is. I don't expect someone who started last month to come in and be the greatest trader next month, right? That's not going to happen. That's never going to happen. It takes an understanding, but if you guys have an average or just above average understanding of ICT, then yeah, that'll work. That'll work. Any final questions in the chat before we head off? You guys can DM me.
So a couple people are asking, I guess, right now, like the link to your Discord or, where
No.
they can find it. So
I think it's which channel is it in Discord? It will be in. I'll put it in the general chat in the 2Degrees Discord. The link to the YouTube video after this. Yeah, and for my Discord, you can head over to poison.com. poiszn.com. I'll just type that out in the chat. Why not? If that's okay with you, Josh.
Yep, I got it posted for you right there.
Thank you. Yeah, so head on over there and use my name as a at the checkout at WAP. Whether you're looking for 2Degrees, LD Pro or StatMap or Elite Collection, use my name at checkout and you'll get a 20% off all 2Degrees. And yeah, if you use that code on my WAP, you'll get a 25% discount on, there we go, thanks Expo. And you'll get a 25% discount on everything there. Again, appreciate all of you guys, and you'll be seeing a lot more of me inside the Escape Discord. And I'll catch you guys in my DMs or Twitter. Let's see what happens here tomorrow, by the way. Would be interesting if this pops down and then pops up, like we said it would. You guys don't have any more questions?
All right.
All right, cool.
Looks like there's no other questions. I was just scrolling up in the chat.
Yeah, are we good, guys?
Yep, everything should be good. And Poison, again, we appreciate you, and we'll definitely see you soon. Okay,
Yep.
Congratulations again.
Thanks. Little sleep deprived with the new one, but trying to manage it all: trading, working, streaming. Okay, I'm out.
All right, right on.
Thanks.
We will talk to you soon. Get some rest. All right.
Thanks, guys. Cheers.
Bye-bye.